Welcome back, class. So we are wrapping up Chapter 9. Chapter 9 introduced you to several different capital budgeting decision models, and now we're transitioning to Chapter 10. Chapter 10 is where we kind of bring together a lot of different things that we've been working on all semester long. So the first portion of Chapter 10 introduces you to one final concept, and that is the importance of determining cash flow uh, in an accurate sense. And we're going to talk more about what that means in the first portion of this PowerPoint. So we're going to identify um, what incremental cash flows are. We're going to determine how to quantify opportunity cost. We're going to take a look at depreciation and cost recovery, and we're going to dig into any cash flows that are associated with the disposal of depreciable assets. Uh, but then at the end of this chapter, we finally kind of get to take all these pieces of the puzzle that we've been learning and put them together so that you can see exactly how all of this information would be used uh, in a real business. Okay, so we're going to learn how to estimate all incremental cash flows and then use them period over period to make actual capital budgeting decisions. Okay, so let's get moving. Now, let's see here. All right, let's get moving. So, the importance of cash flow. Cash flow, you might recall, measures the actual inflows and outflows of cash, while profits, on the other hand, represent merely a measure that is typically used in accounting for periodic performance. And, we learned in, I believe it was chapter 2, how it's very important to differentiate between these two things because as a financial manager, we are making future decisions based on cash flow, right? And so in your book, it shows you some examples of this. So if you look at figures 10.1 and 10.2, they will help clarify the difference between net income and operating cash flow. And luckily, I reorganized this class to where this isn't something that we looked at months ago. This is something that we looked at just a few weeks ago. So hopefully you'll still remember um, when we talked about this. Okay. Um, so recall that some firms have net losses and in a particular year, and that is because of high depreciation write-offs. And however, those same firms can pay dividends from cash balances, while others will show profits. Um, maybe their depreciation write-offs weren't so high, uh, but then they don't have any cash left over, right? So these are examples of how, if we look only to the net income statement, uh, it can misrepresent the liquidity of the firm, right? So cash flow, in essence, is broader than the net income statement can honestly show us. Okay, and so that's ultimately what the goal is to determine for the first portion of this chapter is to get students to realize that cash flow is important and we must do a better job than the net income statement to identify how much cash is available year over year. And so here's those figures. Hopefully you're looking at your textbook. And just looking back at, I don't want to skip over this. So looking back at figure 10.2, you can see that there's a big difference between um, figure 10.1 and then if you look here at figure 10.2, where we have an operating cash flow of, let's see, this is in thousands. So that's actually $4.6 million in cash as compared to only 3.3 million if we were to only use the net income. So I think that's the example that was being shown there. Okay, so that was kind of like a review of chapter two or a segment of chapter two. Now we're going to get into some new terminology. Okay, so when a firm is considering either expanding a current line of business, starting a new venture, or replacing an existing asset with a newer one, the changes in revenue and cost that occur will have an incremental effect on its operating cash flow. Sometimes we use the word marginal for this as well. Okay, and it is the timing and the magnitude of these incremental cash flows that have to be carefully estimated and evaluated as part of any capital budgeting analysis. All right, and so there are 7 important issues that we need to track during a comprehensive cash flow estimation process, and they include sunk cost, opportunity cost, erosion, synergy, working capital, capital expenditures, and depreciation or cost recovery of assets. Okay, and that's what we're going to be looking at over the next few slides, is getting more familiar with these terms. So first up is sunk cost. So sunk costs are expenses that have already been incurred or that will be incurred, regardless of the decision to accept or reject a project. Okay, so you're probably thinking, well, how does that work? Well, a good example is if there is a marketing research study that is used to explore business possibilities in a particular region before a business decides to go to that region to start its business up in that region. So let's say that I'm Bojangles and I'm super popular in the Southeast because that's where I was born. So if you didn't know this, Bojangles was born in Charlotte, North Carolina, right? But let's say that Bojangles is considering going to the Southwest and they hire a marketing firm to go and explore possibilities in the Southwest because there's no current franchises or any locations there, but they want to see, what does the market look like? What's the competition look like? Well, regardless of whether or not Bojangles decides to end up opening a location in the Southwest, any money that was spent on the research is considered a sunk cost. And so, these are costs that, although might be included on an income statement, should not be considered as a part of relevant cash flows when considering any capital budgeting proposal. And the reason for that is because no matter what happens, we cannot recover them. Okay, so that's the most important aspect of a sunk cost. It's non-recoverable. Okay, so burn that into your minds. Then there are opportunity costs. These are not the same thing as sunk cost. Opportunity cost, and hopefully many of you have taken some level of economics at this point. If not, you will definitely hear this term over and over again. But opportunity costs include any cost that may not be directly observable or obvious, but result from benefits being lost, okay? Benefits being lost as a result of taking on a project. So probably need another example. So for example, let's say a company decides to use an idle piece of equipment as a part of a new business. The value of the equipment that could be realized by either selling it or leasing it would be a relevant opportunity cost, right? So instead of using it for the new project, I might ask myself, well, how much could I get for it if I sold it? Or I might ask myself, well, if I didn't use it for the new project, but I instead decided to rent it to someone else, how much revenue could I create on the rental fees? These are good opportunity cost questions, okay? And it's important to note that these costs should be included in any capital budgeting decision. Then there are also erosion costs. And oftentimes students will get these confused with opportunity costs. So do not get these confused. They are two different things. Okay. Erosion costs arise when a new product or service competes with revenue that was previously generated by a product that our company already has, or a service that our company already has. So let's say, for example, that a store offers two types of photocopying services: a newer, more expensive choice and an older, more economical one. Some of the revenues from the older repeat customers will be lost and should therefore be accounted for in the incremental cash flows of the newer service. Okay, so that's one example. Here's another one. And I'm going to add that for the purposes of this lecture, I'm going to discuss these examples, but I'm going to have a separate video that demonstrates how to solve them. All right. But this is a good example of erosion cost. So Frosty Desserts currently sells Strawberry Shortcake Delight, and one of its chefs has come up with a newer, richer concoction, and the chef calls that one the Extra Creamy Strawberry Wonder, and wants to start selling it. And there's data here that provides initial sales and then expected sales, right? And then there's even um, a projected percentage drop in sales of the previous product. And then the problem is asking us to estimate what the erosion costs are associated with this venture. So how much business, or how much sales are we going to lose on the old product when we introduce the new product? That is considered erosion cost, and they must be accounted for when determining incremental cash flows year over year at a particular firm. Okay, so I'm going to go ahead and keep moving with this lecture because this is all information based. And then, as I stated before, there's a separate video that will actually demonstrate how to find the answer to this problem. All right, another cost that we discussed was synergy gains. Synergy gains refer to the impulse purchases or sell increases for other existing products related to the introduction of a new product. So, for example, if a gas station with a convenience store attached adds a line of fresh donuts and bagels, the sales of coffee and milk might go up because I'm now selling donuts and bagels. This is an example of a synergy gain and must also be accounted for in any capital budgeting decisions. Then there's working capital. Working capital investment refers to the additional cash flows that arise from changes in current assets, such as inventory and receivables, and current liabilities, such as accounts payable, that occur as a result of a new project. Generally, at the end of any project, these additional cash flows are recovered and must be accordingly shown as cash inflows. So they are outflows at the beginning of a project, but they are typically expected to come back at the end of a project to be recovered. Okay, so they are represented as cash outflows at the start of a project due to an increase in net working capital. You can think of net working capital almost like a petty cash fund for a small business. We inject money into it to be able to pay for day-to-day expenses and obligations, right? That might occur during the project, but at the end of the project, we expect that fund to come back to the company. Okay, and so uh, we might also include things at the end of the project like liquidation of assets. Okay, and we must also account for the time value of money across the life of the project when accounting for these cash flows, and we'll talk more about that later on in the chapter. All right, so this is the next section of your chapter. When a firm spends capital to acquire a productive, also known as a depreciable asset, it is allowed to expense a portion of the cost of the asset each year. This is a process of cost recovery via the reduced taxes that result from the tax or from the write-off, the tax write-off. Okay, and um, this should not be new information. This should have been covered in your accounting classes, but we're gonna review it today, and then we're gonna refresh our memories by doing some um, problems that involve depreciation, and then we're going to see how this information impacts capital budgeting decisions. Okay, so the portion that is written off in the income statement each year is referred to as the depreciation expense, and you should be familiar with that. And also, the accumulated um, amount of depreciation that we keep track of year over year is located on the balance sheet, and it is referred to as accumulated depreciation. And so, therefore, the book value of any depreciable asset simply equals its original cost, like whatever the firm paid for it, minus or less its accumulated depreciation. Now, we have to deal with depreciation when determining capital budgeting decisions. And there's two reasons uh, for why we have to. The first one is the tax flow implications from the operating cash flows year over year. Secondly, we have to account for the gain or loss when we dispose of the capital asset. Okay, and that's a big deal when we're looking at evaluating projects. And so this leads to the next part of our chapter. I'm sorry, this slide is the one I should be on right now. Um, so this leads to the next part of our chapter, which discusses the two primary forms of depreciation that firms use. And again, this should be a review. The first one is called straight line depreciation, okay? And the second one is called the modified accelerated cost recovery system, or sometimes we just call it the MAC-RS, okay? And every firm is able to choose which one of these methods it wants to use, and oftentimes financial managers are tasked um, with actually evaluating both and determining which scenario is the most profitable and beneficial to the firm. Okay. So let's see. So let's go over each one of them in detail, and then we'll look at some more information that comes with the latter, the MAC-RS. So first things first, straight line depreciation. What is it? Well, this is the easiest one. Straight line depreciation is easy because all we do is we apply the annual depreciation expense year over year. And the way that we do that is we calculate how much to take away or how much to depreciate by dividing the original cost of the item or the asset uh, plus any installation cost, right? Minus any expected residual value at the end. So that's if we expect to dispose of the asset before the end of its depreciable life, its expected life, okay? And then we just divide it by the number of years that we expect to have it in our possession, okay? And so the annual depreciation expenses for straight line depreciation, once we find that total, are the same year over year. So once we determine how much we're going to depreciate in the first year, well, we're going to use that same amount year over year. All right, so it's really easy to determine and then to keep up with. The modified accelerated cost recovery system is a little more complicated. This system was actually established by the federal government in 1981, and it was established as a way to allow for firms to accelerate the depreciation write-off in earlier years of an asset's life. Now, a lot of students would say, well, why in the world would the government allow businesses to do that? Well, you'll recall from other classes that oftentimes businesses are in a significant amount of debt in the first years, like in their startup years. Okay. Well, this is a way to give businesses higher tax write-offs. Um, Sorry, I just had a distraction. This is a way for businesses to have higher tax write-offs during those years where they're in significant amounts of debt, which allows them to claw their way out of debt faster and get into the black, if you will, to start seeing a profit stream. Okay, so it's a decision that each firm must make for itself, but in a lot of cases, it's the one that is used because it has a lot of tax advantages. Now, it's not as simple as straight line depreciation either. So if you'll look at table 10.3, uh, the first thing that a firm must do is it must determine what property class that a typical asset is going to fall into. And you'll notice that these classes are determined based on the type of asset or equipment that is being considered to be purchased. Okay, so that's the first step. We must first determine what category it falls into, and by determining that category, it tells us what the expected shelf life is, if you will, for that particular asset. So, for example, um, if I am considering purchasing office furniture for my business, then it would be in the third row there, and so when it comes to depreciating that furniture, I immediately know that I have a 7 year um, period that I would have to depreciate it across if I was going to use the MacRS system. Once we have that information, we can then jump over to this table. Now, this is the fixed annual expense percentages by recovery class. So again, you must determine the shelf life, if you will, the category that your asset belongs to, and then come to this table and determine how that's going to be used. All right, and so let's talk about what this looks like. So you'll notice something if you're paying attention, you'll notice something that looks kind of finicky. Okay, so let's look at that first column there. In that first column, we have a 3-year asset, and we're looking at the years and the percentages that would be associated with those years, right? Well, you should be noticing something. There is a 4th year on a 3-year asset, and that's probably confusing, especially if you are not familiar with this or if you've never seen it before. Well, this is called a half-year convention. And this is used because the government assumes that the asset is put into use for only half a year at the start, and therefore is only allowed half depreciation. So with the last year or the 4th year, for example, in that 3-year column, that 4th year is allowing there to be a balance that results in 100% total, because remember, these are percentages, okay? And so that's your other half year, okay? And so the depreciation rates in each column must add up to be 100%, because remember, when you're dealing with percentages, everything's out of 100%. So what this does is this keeps us from having to deduct any residual value, okay? And the higher rates are being allowed in earlier years, and lower rates are being allowed in later years. And as I mentioned before, the higher depreciation rates in earlier years provide tax savings because they yield higher tax write-offs due to the time value of money. All right. Okay. And this is the information, I'm sorry, this is the information. I'm doing a terrible job today of having the right slide up while I'm talking. So hopefully you are listening, but this is just the bullet points that go along with what I was just saying. Okay, and so here's another example that talks about how to use the MacRS system to depreciate. And again, there's going to be a separate video that shows how to do the math. But what we see here is we see that Grand Junction Furniture has just bought some specialty tools to be used in the manufacture of high-end furniture. The cost of the equipment was $400,000, with an additional $30,000 used for installation. If the company has a marginal tax rate of 30%, compare its annual tax savings that could be realized from using MacRS when compared to what would be realized if we were using straight line depreciation. So again, the first thing that we would need to do is identify um, the type of asset. And so if you look at table 10.3, specialty tools fall under a 3-year class. And so we know right then and there that we need to first determine what total cost at the beginning are, and then we need to use the percentages provided to us for a 3-year class asset to determine what the depreciation expense will be year over year. And so you'll notice from the example here that we take the $400,000 in purchase price plus the installation cost to get $430,000 total. And then we multiply that $430,000 by the percentages provided to see our annual depreciation expenses. All right, section 4. So when a depreciable asset is sold, the cash inflow that results might be higher than the actual selling price of the asset. And this all depends on whether it was sold above or below the book value of that asset. Okay? If the sale results in a taxable gain, which means that we made a profit on disposing of that asset, then that means that there's a cash inflow, right? And this cash inflow is reduced by the amount of taxes, all right, that we must pay, because anytime that we have a capital gain, we must pay taxes on it, okay? If the selling price is exactly equal, okay, if it's equal to the book value, then the cash inflow equals the sale price alone. And then if the asset is sold below its book value, which means we took a capital loss, then we actually get to submit a tax write-off for the year, okay? Which that results in actually an addition to cash inflows, because a tax write-off would result in a higher cash inflow than expected, okay? So this is very confusing until you see it represented in a math problem, okay? But essentially what we're doing is we are determining what the after-tax salvage value is. And there's a formula that is provided for you in your book, and it's shown here on the slide. However, this is another one of those formulas where you can memorize it and you'll get the right answer, but it makes more sense to ask yourself, what am I actually doing here? So what I would challenge you to do is I would challenge you to just consider this for a second. Every year I'm depreciating an asset, and I'm depreciating it based on whatever system I chose, right? Like I'm the owner, and I either decide to use straight line depreciation or MacRS. And if I use straight line depreciation, then odds are the true market value of the asset is likely going to be closer to whatever my book value is, because remember, my book value is whatever I say it is based on the depreciation system that I'm using. But if I use MacRS, then I'm using um, a federal law, right? A federal system that allows me to accelerate the depreciation of the asset early on in the life of it. So then if I try to get rid of that asset also early on in that asset's life, my book value is going to be drastically lower than the market value. All right? So hopefully that makes sense. So then the question begs, well, what if I sell it? Well, if I sell it and I'm using straight line depreciation, odds are the sale price, the market value, will be very close to whatever the book value is. But if I'm using MacRS, I'm probably going to see a gain. And the reason why is because I'm probably going to be able to flip that asset for a lot higher than what my book value is. Well, here's the catch, folks. if I have a gain, so let's say that I'm able to sell an asset for $100, but on my books it's only worth $50 because that's what I wrote off on my taxes over the past couple of years. Well, that means that I made $50 in profit, right? Well, guess what? I get to pay taxes on that $50 because that's considered a capital gain. And so this is something that we must determine um, at the beginning of the project, believe it or not. We have to determine, okay, what assets do we need to buy, right? How are we going to depreciate those assets? And since this is a project, are we going to keep these assets for the long term? Or do we intend on selling them the second the project is over? And if we do, are we selling them above or below book value? Because if we're selling them above book value, we're going to have another tax outflow, or excuse me, cash outflow, because we have to pay taxes. If we sell it below book value, then we actually get to write that off on taxes and take a cash inflow, which means we would get an influx of cash from that tax write off. Or do we anticipate selling the item as market value equals book value? And if that's the case, then there's no outflow or inflow. It's just we sell it and then we take the money for selling it. But we have to determine all of this information at the beginning because that's our job as the financial manager, and that's what this section is all about. So again, it goes back to the example from earlier. It talks about the same asset that we used in example 2. And so what the problem tells you here is that we decide to sell the assets that we acquired 2 years ago for $125,000. And so the question begs, well, if that's what we're going to do, it's a 3-year asset and we're selling it 2 years in. The question begs, well, what's the after-tax cash flow, assuming that the tools were being depreciated using the MacRS system? Right? And so once again, I've got this example recorded on how to find the answer. But what we want to see is we want to see here that it's like, well, hold on a second. It looks like our sell price is greater than our book value, which means that we made profit. We made a profit, right? We sold this at a market value that is higher than our book value. And since we did that, we have to pay taxes on the difference. So you'll notice here on the slide, it says that my books say that these tools are only worth $95,000, but I was able to convince another company to pay $125,000 for them. Well, that means I made nearly $30,000 in profit, and I must pay taxes on that $30,000. So even though I sold them for $125,000, I cannot represent that $125,000 as a cash inflow to the firm. I must first determine how much in taxes I have to pay on the $30,000 in profit. And that's what you see there at the bottom. So we take the 30,000, we multiply it by the corporate tax rate, we find out what that amount is, we deduct it from the sales price, and then the actual after-tax cash inflow to the company becomes 114,000 because of the taxes that we had to pay. So it's not 125, it's now 114. So hopefully that makes sense. Okay. So basically, there are 4 steps that are typically involved when we are trying to determine projected cash flows for a new project. Okay, and we're going to discuss each one of these steps in detail. But this is really where everything that you have learned up until this point, this is where it really all starts to come together. Because a comprehensive capital budgeting analysis requires that the manager estimate all initial and future incremental cash flows that are likely to result over the productive life of a project, okay? Followed by the application of one or more evaluation techniques that we used in Chapter 9, which are also referred to as capital budgeting decision models, okay? And so here are our 4 steps. Step 1 is the determination of any initial capital investments for a project. What are my initial cash outflows to get this project up and running. Now, they can include the purchase cost of any assets, installation cost, plus any initial increases in net working capital, right? And then we must also subtract any after-tax salvage values from disposals of old assets, right? So you might say, well, where did that come from? Because we were just talking about depreciation in assets. Don't get this confused. This is not an asset that is going to be purchased for this project. This is an asset that we are replacing for this project. So let's say, for example, I'm going to keep it really simple. Let's say, for example, that my new project requires me to have a shovel, and I'm looking at my old shovel and I'm saying to myself, you know what, it'd be nice if I had a new shovel for this project, but I still want to see if I can squeeze every last penny out of my old shovel. So I'm going to sell the old shovel and then use whatever I can from selling the old shovel to buy a new one. Okay, well then any value that I was able to absorb out of the old shovel has to be included, right, in this initial capital investment for the new project, because the only reason why I did it was because I'm taking on the new project. And so it must be actually subtracted from these amounts because it's a recovery, if you will. So that's step one. All right. Step one is purchase, installation, increase in net working capital minus any salvage value from disposal of old assets. Okay, so then your book provides an example of this in figure 10.4. Hold on, is this out of the year one, part two? Interesting. Oh, so the slide, that's interesting. They give you the example on y'all's slides. They give you the example before they talk about it. I would have ordered these opposite. So let me go here and then I'm going to come back here. Okay, so then step two is the determination or estimation rather of the annual operating cash flows. And remember, these are incremental that are going to be generated by your project. And you'll remember from the start of this lecture that we are going to ignore sunk costs, but we need to include erosion cost and any side effects that we might expect. Okay? And so that's why this example comes in handy. So the first place that we're going to look is we're going to look at that net income statement after it's been modified to account for operating cash flows. Okay? Because we need to know what the expected or estimated operating cash flows would be year over year for this project. And you might ask, well, how in the world do you determine that? Well, in most cases, what we do in finance is we look at what our current net income is for a previous year, and then we determine what we think might be a percentage increase or a percentage growth rate in net income due to this new project. And so we would then project that growth rate out year over year, and that would tell us what the operating cash flows might be year over year. So that's just to give you a little bit of background. Okay, it's also important to determine what the operating cash flows will be for the terminal year or the final year of the project. And so you might recall that in the terminal year, we're not only going to expect our typical net income with operating cash flows coming from the net income statement, but we also have to account for any salvage value that might be received when we dispose of any depreciable assets. Okay, and that's where we just learned how to determine what the book value was and then figure out what the after-tax salvage value is on those assets. So here's an example of how this might all start to come together. And this is where I always notice that students' jaws kind of drop because they're like, holy cow, here's the big picture. Here's where we're really beginning to see it all come together. Okay, and there's an even bigger picture that we're going to see in just a moment. Okay, but here's a good example of what I was referring to. So, in year one or in year zero, we can just look at what the actual net income was before we, decide that we're going to take on a new venture. And then what we do is we use that information to project out future cash flows. And so these would be the future cash flows that we might expect from a particular project. I think, your book is still using this bottled pulsar project. Okay. And so what we see is we see a net income statement, but then at the very bottom, we see the operating cash flows year over year. Okay. And the reason why you're seeing a change in this figure is because depreciation is changing. It looks like everything else pretty much stays the same based on this particular project. So the depreciation is the most important thing that's truly impacting the expected operating cash flows for this project. Okay. And so then your book discusses what if we're evaluating two separate projects, and this should all start to be ringing bells for you, right? You should be saying, "Holy cow!" We just learned how to evaluate mutually exclusive projects in Chapter 9, right? And so that's exactly what these tables are demonstrating. They're saying, well, what if you evaluated this project versus this other project? What would those depreciation expenses look like, and how would that impact the operating cash flows year over year? Okay, so there's two more steps before we see the big picture that I referred to. Step 3 is determining any change in net working capital, which is usually an increase. Okay, and you have to get this right. It's an increase in the net working capital account. So when think about accounts like you do back when you were taking accounting 120 and 121, it's an account called the net working capital account, and it's going to increase. However, in terms of cash, this is a cash outflow to the company, right? So it's represented as an investment at the start of the project or the beginning, okay? Then it is considered a reduction or an inflow back to the company at the end, right? So the account is going to be decreased back to zero when the project concludes, and it is considered an inflow because that investment is being recovered at the end of the project. All right, so that's step 3. And then finally, step 4 is an evaluation of the project using the time value of money, right? Because we can't look at all of these future cash flows without incorporating the time value of money. That's the biggest thing that we harped on in Chapter 9. In Chapter 9, we said, hey, there's this method, there's that method, but in reality, the best methods are the ones that incorporate the time value of money. And so moving forward, we're going to focus on two of them primarily. We're going to focus on the net present value method and the internal rate of return. Okay, and you're probably thinking, well, how in the world am I going to use all the information that you've discussed in this lecture and those methods? Because all the examples that we did in Chapter 9 were much more simple in nature. Well, the funny thing is we're going to use those capital budgeting decision models the exact same way. There's just more information that's being provided on the front end. Okay? And so here is a simple version that should still give you a really good idea of how this is going to look. All right. So looky here. This is just like the tables that we have been creating all along. So we have these rows that talk about all the different things that we must consider as managers, all the different cash flows that we must consider either before, during, or at the close of any given project that we are considering. And then they are placed, these rows, these line items are placed at time intervals. This is time 0, time 1, time 2, time 3, and so on, right? And so let's go through this one step at a time. So at time 0, I expect to invest $3.8 million, right? And I also expect to move capital into a net working capital account of approximately $150,000, which for the company represents an outflow because it's an additional investment. And so at time zero, I have an initial outflow of $4 million, right? But then after looking at the projected income statements, and they're not going to represent all that information on this slide because we want you to see what's happening, and then we'll show you a bigger picture, okay? But what we've done is we've determined from the modified net income statements that we expect the following operating cash flows year over year: 2.9 million, 3 million, 2.9 million, 2.8, and 2.8 respectively. Okay, but then in the terminal year, we have more than just the modified net income statement with that operating cash flow. We also expect to recover any money that we outflowed to net working capital. We expect to get it back, right? So that's an additional increase or inflow at the end. We also expect to have a salvage value of two different assets that we were depreciating all along the way. Okay, and so there's a much larger cash inflow at the end of this project than just the income statement, the modified income statement. And then here's the key: at the end, this is bottom line. Now we have the information to apply either the net present value or the internal rate of return method, because we have a singular outflow and then we have individual uneven inflows year over year. So at that point, all we need is a discount rate or a hurdle rate, and we can do the same thing that we were asked to do in Chapter 9. So this is actually what it would look like in real life. So here is an example of a spreadsheet that represents that information, line for line. And as you can see, at the end, it gets really easy, because once we have all of this information represented and we have a rate defined, a hurdle rate or a discount rate, we can then just let Excel tell us what the net present value is, what the internal rate of return is, and also what the modified internal rate of return is, which really is, the easiest part. Even though it ought to be the most complicated, it is actually ends up being the easiest part. But thank goodness for smart calculators, right? And so that is it, folks. That is what everything that we've been learning up to this point was all about. It was so that you could get to this point, so that you could do real world, real life evaluations of any type of project, any business venture. You now know how to do them from start to finish. And again, there are going to be several videos that I post this week that demonstrate how to do each one of these problems from this chapter. So be on the lookout for them. Otherwise, I hope you're all doing well, and I'll talk to you soon.